So in this question, we've got a parent company called PriceArt, and they're in a country called Marteg. Okay, and Marteg has M dollars. All right, so that's the holding company, the parent company. And what they're doing is they're going to buy a subsidiary, and that subsidiary is Elan, and they're going to get a new project in that subsidiary where they buy and sell a new phone. And Elan is in E dollars. But we're doing this from the parent company's point of view, okay? So the first thing we're going to do is deal with all the figures that were given in the subsidiaries, because that's where the investment is. So the buying and selling of the phone, etc. Start with all the ED figures. But because we're doing it from the parent company's perspective, we're going to then translate all those ED figures into M dollars. And then there might be some things finally that's just all dealt with in M dollars, so we deal with those at the end. So there are 3 steps to get through this. Do the foreign bit first, then translate it, then any extra bits that we're looking at. Right, let's have a look. So over here then, the board has specified a 4-year time horizon for the investment in Elan. So that's good, isn't it? So we can start that immediately. Year 0, 1, 2, 3, 4. Expected sales revenue is as follows, okay? And then he gives you the sales revenue in ED, which is what I'm working in at the moment there, look. So 8,000, 10,920, 14,641, and 16,670. So giving it to you. Okay, so that's the sales put in, nice and straightforward, given to you. Just notice that I'm using commas here, just makes life easier. It was something that was brought up in the examiner's report as well. So the new phone will require a component made in our country, and we're going to charge $7 each for it in year 1. Okay, so I want the exchange rates, and I want the exchange rates for each of the 4 years, because this is in our currency, and I want it in ED for the moment. And so I look for exchange rates, but all he tells me is the current exchange rate, which is year 0. So in year 0, the current exchange rate is 2.6, okay, to the dollar. That's the counter currency, isn't it? 2.6. If you remember, to calculate, he gives you inflation, predicted inflation rates. So if he gives you inflation rates, you can then use purchasing power parity to calculate the exchange rate in year 1. So you're going to take, it's counter base, if you remember. So we're going to go in there, equals counter times by 1 point the counter inflation rate, so the counter currency is Elan, so 1.06, divided by 1 point base, the inflation in the base country, us, 10%, 1.10. Okay, and then you say, right, next one, the counter exchange rate is now 2.5055. Times by 1 point, inflation in the counter currency, 4%, so 1.04, divided by 1 point, the inflation in the home country, 9%, 1.09. Then you say, right, that's the currency at the moment, that's the exchange rate at the moment, times by 1.03, divided by 1 point, the inflation rate in the base country, 1.08. So we're just using purchasing power parity, counter base. Get the counter currency, times it by 1 point, the inflation in the counter currency land, 3, and divide it by 1.07, the inflation in the base country, Marteg. So now we know all them, we can work out the component cost. And for year 1 then, you think, right, well, how many are we selling for? How many are we getting? 50,000 units. We're doing these in thousands. So 50 times by 7 times by the exchange rate at the end of year 1 is 2.50555, and then you think, right, it is a cost, so I want a negative in, and I'm done. do the next one. Equals 65,000 I'm going to need. So 65 times by 7 times by the exchange rate then. And remember that one of them is a negative to show it as a cost. 83,000 components at a cost of 7 of our dollars, but the exchange rate now is that. Make it a negative to show it's a cost. Done. And then finally the same thing. 90,000 times by $7. Exchange rate then predicted is that. Make it a negative to show it's a cost. And we are on our way. Then he says the transfer price will increase by the rate of inflation each year from year 2 to 4. So you think, right, okay, that's not quite right then, because I need inflation in years 2 to 4. So you go to our inflation figures. Because you've done it in on a spreadsheet, it's not so bad. So you think, okay, year 2 then. The inflation wouldn't be 7, it'd be 7 times 1 point, whatever the inflation rate was. It's in our currency, isn't it? So 1.09. Go into the next one, 7, but then it increased by 1.09, and now I'm going to increase it again by another 8%. So times by 1.08. And then finally in year 4 then, you just go in, you change that, you say it wasn't 7 because inflation was 1.09, then it was 1.08, and then it was 1.07 in year 4. So a little bit tricky, but I know the examiner said it wasn't very well answered, this bit, but we can do it. So the question then, it says the parent company will achieve pre-tax contribution of 35% on sales, so that'll be in M dollars, so I'll deal with that later. Investment in the new phone is likely to mean the loss of future sales, so we're going to lose some money. That's all in M dollars again, so I'll deal with that later. And so now I'm down to this. Other costs are forecast to be as follows, already taken into account inflation. So here's some other costs, and it's already in the foreign currency, which is, remember, what I'm dealing with at the minute, so I can just put those in the other costs. Okay, notice these don't have any commas in them, so all you do is just go up there and you look for the one with the comma in there. Put that in and you're done. Okay, so that's that. Just tell me now that we've got an investment of 14,460, so I can put that in because that's all in ED, so investment minus 14,460, yeah. And then it says at the end, the realisable value is 3,400. Remember, there'll be no tax on that. You only get taxed on your profits, don't you? All right, so we'll leave it at that. That's the ED bit done. We'll go and have a look at some tax effects next.